Welcome to Candlelight, where price is a mechanical function. In this video, I'm going to be going over how legs work, what are the characteristics and what constitutes a leg, and how it ties into swing lows and swing highs. And a swing low and swing high is essentially a price curve. Now, if you haven't seen the price curve video, it'll really help to understand this one. But a price curve tells you where you are relative to where current price is from demand and supply. If you are low, then you are most likely in some form of demand, and if you're high, you're most likely in some form of supply. But you need a price curve to tell you that. In other words, the origins of legs. If you're high in the price curve, because price falls when it's high, it has to. You can't fall when you're already on the ground. You want to be focusing on selling or shorting. And if you're low on the price curve, which probably you're in demand, you should be focusing on buying or buying to cover. Now, it does not matter what asset class you're looking at. Because all markets work on supply and demand, the only way you can execute supply and demand is with buy and sell orders. So it's a mechanical function. They're what used to be pieces of paper, now they're electronic, but it's a mechanical function, which is why I've always said a chart is a chart is a chart. That might sound ambiguous, but it's perfectly true. Any chart you're looking at, and we're going to be going over a stock, but it applies to futures, options, currencies, cryptos, does not matter. All price and all markets work on supply and demand, so it works in the exact same concept or in the exact same mechanics. So let's jump right in. All right, I'm going to be going over Chevron from the energy sector, obviously stocks, and I want to draw your attention, or before I do that, I want my left hand chart is a daily chart. Every candlestick represents 1 day's worth of price action. My center chart is a 240-minute, so 4-hour chart. And my right hand chart is a 60-minute. So I'm going to be going over two legs that give you two price curves. This leg here gives you this price curve, so relative demand and relative supply, and then how this leg here gives you this relative price curve. So this swing low and this swing high, in this area you should be focusing on buying. In this area, you should be focusing on selling. Now you're in an uptrend, so when you're in an uptrend, you want to buy low and sell high, and then buy low and sell high, and so on and so forth. So it's not like you have to wait for price to come all the way down here. This is the ultimate swing low of this whole move. This is where the most amount of demand exists. But when you're in an uptrend, price is obviously going to be going higher and higher, higher. But you want to be able to buy low and then sell high as you continue. So let's go over the first leg and how it gives you this swing low here. Now all legs should have these three characteristics, or at least one of these three characteristics, and preferably will give you all three. Any leg should have a demand zone within the move. So let's just say to the upside, it would have a rally base rally. The origins of all strong moves is where demand exists. So if it rallies bases, you have an equilibrium of supply and demand, and then ballistic movement to the upside. That's obviously an imbalance of, if it's to the upside, demand. Same is true to the downside. If it's in a downtrend or a downtrending leg, you should have at least a drop base drop, or some kind of other supply zone, which would be a drop. It falls, it rallies bit, and then it makes another lower swing low. So you want to have some kind of leg. It should also make another swing high. So you have supply zones or demand zones, and then a swing high or swing low, or this is the third one. It should break an opposing swing, swing high or swing low. Let's go over the three examples here. In this uptrending leg, you have a rally base rally. I know there's a gap here, but any gaps, particularly in stocks, there's a lot of gaps. Any gap, you just treat it as a large candle. So a rally base rally base rally. This leg has demand zones within it. It also broke opposing swing highs. This one, so on and so forth. It even broke this entire swing high within the whole leg. And within this rally, it breaks its own swing highs. So there, let me make this bigger. So it has a rally, a drop, and then it makes it another, higher swing high. So this whole leg has all three characteristics, which is great. That's what you want to see. They don't have to have all three, but it really does help if they do. And the same is true to the downside. It would have drop-based drops. It would break opposing swing lows, and it would also break in its own little drop, its own little swing lows and swing highs, or it would break its own little swing lows. So those three characteristics is what a leg should have. Now on my price curve video, I'll give you a very easy example, a very simple example on if you want to know where the origin of your price curve is. You just have an uptrend, and then any leg that breaks your trend line right there, that's the origin, or that's your most current swing high of your price curve, or that's going to be the high of your price curve. And then if you're in an uptrend like here, you want to be buying low, so you want to wait for a short-term downtrend to be broken, such as this one, and the origin of the leg that breaks that downtrend will be the low of your price curve. In other words, the swing low of a rally, which would be here. And then you just wait for price to come back down into demand, and since you're in an uptrend, price should make higher highs and higher lows. Another qualifier, this leg made a higher swing high than this one, and then this leg made a higher swing high than this one. So that's how you get your relative high on the price curve and low on the price curve, which this is your swing high to the downside and swing low to the upside. But how do legs tie into this? Well, there's a reason why this rally did not give you your swing low. And a fantastic example, or another qualifier, or not another qualifier, but another fantastic example as to why this was your swing high was, do you see it has a drop base drop? It didn't break a swing low, and it didn't break any kind of demand zones here, but it had within it a drop base drop. That's a leg. It has at least one of the three characteristics. On top of it also being the leg that broke your downtrend, or that broke your uptrend on top of that. So this is going to be your swing high, or the top of your price curve. But the reason why this swing low that also had its own mini demand zones and broke opposing zones, like this drop base drop, this supply zone here, it broke above that right here. Why this didn't hold? Because it didn't come into the origin of this overall uptrending leg right here, this leg. This leg is made up of two legs within it. Let's make it really simple. This leg here is made up of this leg and this one. So 1, 2. And the reason why it's made up of two is this first leg here, right here, rally base, rally base, rally, nothing was broken until you had a drop base drop. That's a mini downtrend. That's a mini leg to the downside. Just like this concept of this supply zone here being the origin, or being the leg that broke this trend line, which gives you a supply zone and then it falls. The same is true here, where this downtrend was broken. The origin of that leg that broke this downtrend, that's where demand exists. And the first touch, let me clear this out. And the first touch into those zones often give you a bounce. After this supply zone broke your uptrend, the first touch in, it fell. This demand zone that broke this small downtrend, when it enters, it rallies. So not only do you want to have an origin of where price broke a mini downtrend, like right here, the reason why legs are so important and how they tie into this whole concept of a price curve, where you're now low in demand, is this is the origin of a leg. That's where you should expect to see the low of your price curve. This demand zone here, that was just profit taking. People who shorted here bought to cover for profit, and that's why price kind of rallied a bit. But that's not going to be your swing low. Your swing lows want to tie into the origins of legs. This first leg here, the origin is down here. But we're not expecting price to fall all the way down there. That would just, I mean, it does happen, but it would be kind of unrealistic since you're in an uptrend and you're going to be buying relatively, high relative to this whole move. But relative to where price was, let's just say up until this point, this is now your swing low of this price curve. Your swing low, your swing high, and now this is low on the price curve and high on the price curve. So you want to be selling here and buying here, which is why price reverses from this area. The origin of this leg occurred right here. That's where you should expect to see your price curve be created. Now you can buy here, that's a little aggressive, but what you want to be seeing is, since you don't want to be buying in downtrends, and right here you have a high, low, lower high, lower low, you're in a downtrend. You want to wait for this downtrend to be broken, POW, thus confirming your swing low or your area of being low on the price curve. And that's where you want to buy, and that gives you this leg. Now let's go over how this leg is going to give you a very good probability on telling you where this price curve is. So you're in an uptrend, but you want to buy low. Where is that low going to occur? Well, right here on this whole leg, this long-term leg or uptrending leg, you can pretty much divide it by two. The first half is this one, and the second half is this one. The origin of all strong moves is where an imbalance of supply and demand exists. And in this case, where demand exists, price comes back down and then rallies. But again, this is an aggressive trade. What you want to be doing is exactly like we did here, where this downtrend got broken by this leg to the upside. When it re-enters that demand zone, you go long. Now this one, this demand zone worked. It gave you, when price entered, it really rallied to the upside and it made a higher swing high. It doesn't always happen. Sometimes price doesn't always make a higher high after price comes in to your demand zone, such as right here. You did get a bounce, but that was the end of the trend, and then that's why knowing where you're on the price curve really helps, because you can't always expect for the trend to continue forever. In this scenario, it pays to have bought low and then sold high and shorted to the downside. But what you get here is almost the exact same example of this swing low not being a real low point on your price curve. It got broken, and then this lower low, that became the low of your price curve because it was in the origin of this ballistic rally to the upside right here, not this one. Same is true here. The origin of this leg that has base rallies, it made a higher swing high, right? So it has two of those characteristics that we're looking for out of the three. This demand zone is where your relative swing low, or where your swing low came from, which gives you your relative low on the price curve. Not this one, because this one, while it did break a downtrend, while it did break this downtrend, it did not occur or move out of your area of demand. This is just people who shorted here are taking profit here, just putting buy to cover orders in, making price go up, and then it continues to the downside. Just like we did here, where you want to wait for the downtrend that entered your demand zone to be broken by this leg, then you want to buy the demand zone that broke this short-term downtrend. Right here is the exact same scenario. Right there, this is the leg that made a higher swing high. It had demand zones, rally, base, rally, and then it also gave you higher swing lows and higher swing highs. So this is the low of your price curve. When price re-enters, that's when you want to be buying, and then hopefully price will continue to the upside. If it doesn't, that's why you have a trend line. And if you did buy low down here, you would have cashed out for profit and still be safe, even if you didn't short at the high. Now that's the explanation of how you got the low point of your price curve. Now, once again, how you got the high point of your price curve. And I know price made a higher high, and then you would have hopefully expected price to continue to the upside, but that's another explanation for another time. The fantastic short was right here. And again, I'll go over that on another video. Right there. But how you got the high point of your price curve, again, you have your leg to the upside. Not only is it the origin of the move that broke your uptrend, it also has supply zones, drop, base, drop. So ballistic movement to the downside, giving you supply zones. It broke opposing demand zones, such as this rally, base, rally, this and this rally, base, rally. And it didn't quite it didn't break its own swing lows, since these are just drop, base, drops. But the whole thing from here to here to all the way down here, it was breaking its own swing lows. So high, low, lower high, lower low. That's the origin. So it qualified with all three characteristics, thus giving you the high point of where your price curve is. So it's as simple as that. All you got to know is the origins of legs, such as this one and this one. That's where you should expect price to bounce from, thus giving you now your current swing low. And then since this one was the origin of this leg to downside, that's your swing high. And now you know where you should be buying and selling, because now you have a price curve. Low on the curve, high on the curve. And the only thing that does that is the origins of the initial leg, or the legs that make price go, in this case, to the upside, the origins of those big rallies. Wait for price to come into them, and wait for that trend line to be broken, or that downtrending trend line to be broken, in those zones. If it's not in a demand zone, it's just profit taking. Expect for you to get the low point of your price curve in those areas, and wait for it to happen. Waiting pays. I covered that in another video, but this is, but anyway, that's another topic for another video. So I hope this helped. I hope this gave you a really good understanding of waiting for price to give you zones where you should be looking into, but you need to wait for price to give them to you. And when you understand the origins of legs and how they work, and how to qualify them and identify them with a higher swing high, they break opposing demand zones, and they break opposing demand zones and supply zones, because it's both to the upside and downside, and it breaks opposing swing highs and swing lows. If it has either one of those three or all of them, that's a really good indication on where price is going to be giving you a swing high and swing low. So I hope this helped. I'll talk to you guys on the next one.